In this session, there is a lot of uh, uh, definitions and all, which are prices which are more associated with the bond pricing, which we have done using the spot rates as well as the yield to maturity. The next 2 to 3 chapters are more focused on those aspects. Then again, to some extent, we'll talk about the durations, convexities, right? And after that, again, there is one or two more aspects where we bring in something called key rate, duration, and all, which are slightly more comparatively tougher specific interest rate kind of concepts, right? But all these should be a quicker walk for us. We'll just see. So typically, when we are talking about the various cash flows in a bond, we are talking about the coupons as well as the maturity amounts. And whenever we talk about the price of the bond, we are just simply saying the present value of the future cash flows. Even using your calculator, you can do that, right? The present value of the future cash flows is what we are calling as the value of the bond. So if the bond is going to give me a coupons of, if the bond is going to give me a coupon of 10 for the next 4 years or next 5 years, and probably a maturity of 110, 100 on the maturity, and let's say the currently prevailing market interest rate is 8%, the net present value, at what price should I purchase this bond? The price at which I can purchase the bond is nothing but the net present value taking 8% as the interest rate and taking these as the 4 different cash flows. So I can say the worth of the bond can be 106.62, right? Which is where I call this bond as a premium bond, because I'm spending more than the face value. If I'm spending more than the face value, I'm calling it as a premium bond. If I spend less than the face value, I call it as a discounted bond. So probably if the market interest rate is 12% instead of 8%, the market value of the bond is only 93.93, which is where we call this kind of a bond as a discount bond. Simple logic. Look at your coupons, the periodic payment. What is the interest rate of this periodic payment? 10%. 10% of the face value, right? When the face value is 100, when these are paying 10, 10, 10 every year, the interest rate or the coupon rate is 10%. You compare that coupon rate with the market interest rate. If the coupon rate is lesser than the market interest rate, we call it as a discount bond. Coupon rate more than the market interest rate, when I put the market interest rate as 8%, we got the price as 106, which means it becomes a premium bond. And when the coupon rate is same as the market interest rate, it becomes a par bond. Price will be same as the face value at par kind of a bond. So that is one quicker way of assessing whether the bond is a premium bond or a discount bond or at par kind of a bond. Okay. So whenever we are doing the valuation, all what are the steps we are doing? We are finding out what are all the future cash flows. This we are estimating, right? In some bonds, everything is fixed, right? In a regular typical bond, everything is mentioned in the indenture, so everything is fixed. So the future cash flows are known. Then I have to estimate what is this one. This one keeps changing as per the market conditions, right? Today the interest rates are something, whereas after 6 months that rate could differ. So depend. So that rate, either I may have to forecast or I may have to take the current one, whatever it is, right? Spot rates, forward rates, those are all coming from those kind of standpoints. So those are the interest rates. Then finally, once I know these two things, the future cash flows as well as this. I can discount both of them to the present value and I can find out the value of the bond, right? So the only uncertainties in this process for some of the bonds, this may be an uncertainty because let's say we are talking about mortgage bond, prepayments can happen, right? So I cannot clearly say that this is the amount that I will get after 1 year, this is the amount I will get after 2 years. If a prepayment happens or if a delayed payment happens, the amount which I am going to receive is increasing or decreasing. Or look at a callable bond. The company can call back at any point in time after 5th year, let's say, if that is what is mentioned in the indenture. I don't know when they are going to call it back, right? When they are going to call it back, I'm not sure. If they call back after 5.5 years, the value could be something else. If they call back after 6 years, the value could be something else, right? So for some kind of bonds, this could be uncertainty. For some kind of bonds or for most of the bonds, this is an uncertainty. But better predicting these two, we can find out the value of the bond by simply finding out the present value of all these future cash flows using this particular rate of return. That is what is the valuation process. Now, when I am talking about the present value, we are discounting each of these cash flows, right? We have to discount each of these cash flows. So what we are saying is, whatever the rate which we are using to discount each, whatever the rate we are using to discount each of these cash flows, right? Probably if I am discounting it by 10%, how much is this? Probably if I am discounting this by 10%, 1 plus R or E per R, continuous or discrete, probably will ignore that part for the time moment. So it is actually 9.09. What we are saying is the discount factor, whenever I use the word discount factor, it is nothing but the discounted value by the actual value. So we'll say the discount factor is 0.90. So what does that mean? If the discount factor is 0.90, as simple as whatever is the cash flow here, if it is 10, you multiply 10 with 0.90. If it is 40, you multiply 40 with 0.90 to find out the present value. Those are what are called as the discount value. Sometimes what in the exam he will do is, instead of giving the interest rate like this, he'll give this is the discounted factor, right? If he has given the interest rate for you, probably you are doing either 1 by 1 plus R or 1 by E per R, whatever. But what he is doing in this case is, instead of giving you the interest rate, he is giving you the discount factor for 1 year. You use a discount factor of 0.9, which means probably you can translate it. Discount factor of 0.9 means you are going to get 9.09. Now, if you want to find out the interest rate corresponding to it, you can very well find out something divided by 1 plus R is equal to 9.09. From there, you find out that something which will give you whatever is the interest rate for the period. So you have to do a kind of reverse calculation in case the discount factors are given. So for each of the period, he will give a discount factor. Discount factor for 0.5 years, discount factor for 1 year. So which means the 0.5 year cash flow, you multiply it with this number. The 1 year cash flow, you multiply with this number. If it says 1.5 year cash flow, you multiply with this number. That multiplications will give you the overall present value of the bond. Right? So probably if he says, okay, the discount values, the discount rate factors for 0.5 years or 1 year or 1.5 years. Let's say this is 0.95, 0.9, right? If he says this is 0.9 and this is 0.83, some kind of such numbers he'll give. Using this, you find the value of the bond, which will pay 10 here, 10 here, 110 here. So then what you are saying, simply you multiply each cash flow with its corresponding discount factor without finding out the interest or whatever. You multiply each cash flow with its corresponding discount factor and finally you add up. 109.8 is the typical worth of the bond. Now here the discount factors need not follow a pattern also, right? Which means you can use them even to derive your spot rates. Right? This is, see, when I am using this 10% for all the periods, I'm taking the 10% as a base itself, which means it's like a yield to maturity kind of scenario. Whereas if I have these kind of discount factors, probably let's see what are our interest rates here. How do I find out what is the interest rate based on this discount rate factor? 1 by 1 plus R. That is equal to 0.95. Or probably 1 by E per R. Whatever it is. Depending on whether I am using continuous or discrete, I will go with that particular aspect. Okay, so from this I will get 1 plus R equal to 1 by 0.95. From here I will get my R. Okay, if I go with that logic, what are the rates here? 1 by, if I am doing a 0.95, this is 1 plus R. If I do a minus 1, this is what is my 1 year rate, 5.26%. Now the same thing what I will do here, 1 by 1 plus R whole squared is equal to this much. So 1 plus R whole squared is 1 by that much. So 1 plus R whole squared is this much, 1 by this. Now what I can do, if I want 1 plus R, I'll take a square root of this. Right? If I want 1 plus R, I'll take a square root of this and then minus 1, which will give me R. So this R is 5.4%. A 1 year R is 5.4%, a 6 month R is 5.2%. The same logic I can extend it for 1.5% R. This is as simple as your spot rates. Right? This is, so the discount rate factor actually helps us, even if the interest rates are different for each of the periods. The moment I know the discount rate for each of the period, I can do a better valuation of the bond. That's the only additional input that is coming from our previous cases. I mean, in our previous examples, which we have handled in the discount rate kind, I mean, in the interest rates kind of chapters, the way we have handled them is, given a spot rate, how do I find out the value of the bond? Or given a yield to maturity, how do I find out the value of the bond? But here he is not giving the spot rate or yield to maturity, he is converting that rate into a discount factor, which is more easier to compute also, because I don't need to think of should I use a continuous rate or should I use a discrete rate. Do I use a continuous compounding or semi-annual compounding? Whatever is the discount rate he has given, use that discount rate, multiply the cash flows to arrive at your value. Only if he asks you to compute the spot rate or compute the interest rate from the discount factor, then you have to think, okay, should I use 1 by 1 plus R or 1 by E per R? But as long as the questions are about use the discount rate, discount factor to compute the price of the bond, no issues at all. Right? And typically, the see, whenever we talked about a coupon based bond, right, this we have already discussed, the coupon based bond, we are saying we'll strip it off into so many zero coupon based bonds of different maturity. And we have also discussed that if I sell it as a combined bond or a stripped off bond, right, there should not be any kind of arbitrage opportunity. Otherwise, what people do, they will buy the cheaper of these two, either buy pieces, join and sell as a combined instrument, or buy the combined instrument, strip it off and sell them as separate pieces. So that will give them an arbitrage profit. Without any additional risk, they are getting a profit, which is what is creating an arbitrage profit. And if that same has been extended to high volume, it can generate a huge profit, and that arbitrage opportunity can actually get erased out. So that is where what we are saying is the law of one price mechanism says whether I am selling it as a combined instrument or a bits and pieces kind of an instrument whose interest rates are different for different maturities, both of them should give me the same pricing. Otherwise, people will take advantage of buying the cheaper one and selling the across the various markets. Just not within a particular market, even across the geographies or any kind of scenarios, wherever this arbitrage opportunity is available, they will definitely exploit that opportunity. And that is where what we are saying is, if at all, if at all there are two different prices for the same kind of an instrument, for the same level of risk, for the same level of future payments, everything remain the same if they are available for two different prices. As simple as, let's say, the same share on NSE and BSE, it is available at two different prices. People will immediately exploit that opportunity, assuming no other costs are there, no transaction cost, no brokerage cost. If I assume that kind of a picture, the moment there is a difference in the prices on NSE and BSE, at the same time I can execute both the trades, buy here, sell here kind of a trade, and I can very well make a profit. And that too, if I am doing it in large volumes, my profit is also maximized, right? So that's where it says the law of one price is simply saying that the same product with everything remaining the same, no other costs coming into picture, it cannot be priced in two different ways in two different markets. People will try to exploit that kind of an arbitrage opportunity, assuming that no other interventions are there in place. So just to understand a typical the US, what kind of bonds which typically US government issues, we are talking about a treasury coupon kind of a bond. So most of the times the US government issues only coupon based bonds. It does not issue zero coupon bond, but it gives the flexibility to strip them off. Main issue wise, they still issue coupon based bond. Generally for 10 to 30 years kind of stuff, where the coupons are paid on a semi-annual basis. And from a benefit standpoint, they are exempted from the taxes and they are non-callable kind of bonds in most of the scenarios. But on the top of them, they allow them to be stripped. The dealers can pitch in, they can strip the bonds, all the coupon bonds, sell the interest separately, coupons separately. They can do this process. But here comes the real problem. See, typically, when we talk about each one is a zero coupon bond, all of them have to be sold at a discount to the face value, right? Because they are all zero coupon, no intermediate payments, everything is paid on. Probably if there are 10 year coupons, right, the fifth year coupon becomes a 5 year zero coupon bond, which matures after 5 years. So during this 5 years, no interest is paid on that. But still, as per the law or as per the taxation laws, what it is said is, especially on your coupon strips, even though you are not receiving any interest in the middle, you have to pay tax to the extent of accrued interest. So the reality, what it is happening is, without getting a rupee of money, you are paying a tax, especially for coupon strips. This is not applicable to a principal strip. For a coupon strip, The investor, see, let's say the coupon of 100, right? So let's say the maturity part is 5 years. So today it is issued at 60, right? Probably the accumulation, probably after 1 year, because of the interest, it may become 67, then 78, 75, then 84, then 93, then 100. Let's say it is happening like that. Now at the end of 1 year, you have got a return of $7. What it says is that is like a accrued interest for you. Though you have not got that money, it is an accrued interest for you. And what the law says is, corresponding to that bond accretion for that year, a tax has to be paid, which means cash flow wise you have got zero. I mean, if I look at only that scope, cash flow wise you have got a zero during that year, but you are paying a tax of some 30% on that 7. Whatever the excess you have got, some 30% of 7 is what you are paying a tax corresponding to it. That is where probably there should be some see, in a normal case, probably after 5 years the 40 has to be looked at as your gain, and the tax on 40 has to be paid. But in this kind of interest strips, coupon strips, what typically comes out is the tax is levied at each of the period, whereas in principal strip that is not applicable. One. Two, we always see, if the interest rates are going lower, if the interest rates are going lower, the treasury strips are more and more attractive. The reason being, they have a 5-year maturity, 10-year maturity, and today they have issued this assuming some 8% interest in the market. They are discount, let's say 100 will be paid to you after 5 years. Let's assume 8% interest. So what will be the present value? This divided by 1 plus 8% to the power 5. So probably today it is available to you at 68. You pay 68 today. After 5 years, it is going to pay you 100. Right? So in this process, what is happening? Every year you are getting a guaranteed 8% return. But let's say the market interest rate during this 5-year period, they have gone to 6%. Because there is no intermediate payment in the middle. There is no callability associated with them. You are assured of 8% for 5 years. Right? So, but if you get something in the middle, some coupons are coming out in the middle, you have to reinvest them at 6% only, which will give you a loss. So that is what we are saying. These kind of trips are very much beneficial to the investor if the interest rates are typically falling down, because there is no reinvestment risk at all, no middle amount coming in, no intermediate amount coming in. That is where the investor is completely safe off, secured off. And but on the lower side, on the downside, what we see is generally there will be a lot of illiquidity for these kind of instruments. And yeah, short term coupon strips, they will trade for a richer. So probably if you see the coupon of 100, a 1-year coupon, I mean maturing in 1 year. So probably that will be trading probably at 92. And generally also we have seen earlier that the interest rate, short term interest rate should be much lesser compared to the long term interest rates, for the simple reason of liquidity premium. Right? Apart from the expectations and all, the liquidity premium comes into picture, which is more of a motivation factor. The reason why I want a long term investment is I want a kind of extra return. Otherwise, why should I block my money for a longer period? But even from that standpoint, if I am just going for 1 year coupon strip, which will pay 100 after 1 year, it will be sold at 92, whereas a 5-year strip will be sold only at 68. Right? Generally, what we see is smaller term coupon strips are sold at a higher price, and the long term coupon strips are sold at a lower price. But at the same time, the risk that is involved in both of them is completely different, because the longer term one is exposed heavily to interest rate risk, whereas the shorter term one is slightly lesser exposed to interest rate risk. So even those have to be reflected. Whereas when it comes to P strip, generally it will be traded at fair value itself, not at a premium or not even at a discount. It's more or less traded at a fair market value itself. And if there is any kind of mispricing based on the calculation of the interest rate, based on this, see, let's say it should trade at 92.59, but if it is available at 93 or 92, companies will take an advantage of it, either buy pieces and combine, buy all the strips and combine into a bond. So sell the bond as a package, buying all the strips, or they can sell the strips and buy the bond as a package. So even if this small change occurs, assuming no other costs coming into picture, the large corporations can either get into reconstituting of the bond by combining the pieces, or splitting the bond by breaking it into pieces. So that is where we are talking of C strip and a P strip. C is more to do with the coupon, P is more to do with the principal. And income tax has to be paid on the coupon strip, whereas on the principal strip we are paying only capital gains tax. No accrued interest comes into picture. Only when the typical sale of the principal strip is done, only then the tax is paid on it. So there is no accrual part in the middle on the principal strip at all. And so that's where we use this word saying coupon strip will have a negative cash flow until the maturity, because you are getting literally zero, but you are paying taxes every year on that accrued part. So it is actually accumulating a negative cash flow over a period, and people can always either they combine or they can split and create those arbitrage opportunities. And in general, whatever we see is maturity of the bond will play a key role in the pricing. So probably if we see here, the price is 93. Let's say I'm not talking about a 4-year maturity bond. I'm just talking about a 3-year maturity bond. Suddenly the price has become 95. Right? The shorter the maturity is, and probably if I extend it a little bit more, the same logic, if I extend for 5 years, this is only 92. So maturity is playing a very important role in the price of the bond. Right? And the longer the maturity period, the longer is the fluctuation in the price. Right? Even if I am seeing 8 years, 8%, this is 107. But if I put it shorter, this is becoming 106. So if the maturity is increasing, the price of the bond is varying very heavily from the par value. From the face value, either it is available at a much bigger discount or much bigger premium. So the maturity is playing a very important role in the price of the bond. And the same logic goes with the coupon. If the coupon is becoming higher, you see 12, coupon has become higher, the premium on the bond has gone up drastically. So what you can typically see for time being is higher coupon, it becomes a premium bond. As the coupon keeps increasing, the premium keeps increasing. As the coupon keeps decreasing, the premium comes down and probably it may become a discount bond also. So that is one. Two, maturity. If the maturity is increasing, longer time to maturity, then there is a good chance of deviation from the face value. Very short term to maturity, the deviation from the face value is also limited. So that's where we see that these two factors, especially the maturity as well as the coupon rates, they play a very influential role on the price of the bond, right? So yeah, now this we have already talked about, computing the discount factors from swap rates. The interest rates being given, and I have to compute the interest rates are being given for each of them, and we are trying to find out swap rate is nothing but the fixed rate, right? When someone has entered into a swap transaction, whatever is the fixed payment that has to be done, and we have seen the equations. Typically, let's say we are talking of the first instance 1.3%, right? What is that a fixed rate payer will pay every time? He'll pay 1.3%. So if I assume that the face value is 100, if I assume that the face value is 100, he will pay at the rate of 1.3% per 1 year, which means for 6 months he will pay 0.65%. So overall he is going to pay how much? 100.65. That is what is a fixed rate payer is going to pay after 6 months. So I can find out the present value of that. So 100.65 by 1 plus R. Now what is the floating rate payer going to pay? We said the day on which the interest rates are going to change, the floating rate will be equal to the par value itself. The value of the floating rate payment will be equal to the par value itself. So I will always equate this equal to 100. Now based on this, I can find out what is 1 plus R. 1 plus R is probably 1.0065. Then R is becoming 0.0065, which is 0.65%. So I am getting that the interest rate for the 6-month period is 0.65%. Now, once I know the interest rate, how do I find out the discount factor? We have seen already, right? So, or the other way of talking about is 100 by 100.65 will be the discount factor. Now, the same logic, if I say, okay, 1 year swap rate is 1.6%. What does that mean? After 6 months, I will get 0.8, assuming it's a half yearly payment. After 6 months, I will get 0.8. 1.6% is for 1 year. So 0.8% is for 6 months. 0.8% on 100, which is 0.8, I am going to get after 6 months. And probably 100.8 is what I will get after 1 year. Right? This I can discount it based on this. This I can discount it based on the discount factor which I have got, or probably based on this 0.65%. I can discount it because this is like a spot rate for me. I can discount this cash flow with 0.65%, whereas this cash flow I don't know how much I have to discount it with. But this is the fixed rate payer's perspective. Floating rate payer's perspective is always equal to the face value on the day when the interest rates are typically changing. Now from this I will find out what is R2. The same thing I will go with R3, R4, which means I am getting the spot rates. Using the spot rates, I can find out what are the discount factors. Just like the way we have done it in that Excel sheet, using the spot rates, I can find out the discount factors. So typically, we should be comfortable in making these kind of calculations from the swap rate. How do I find out the spot rates? Because swap rate is more like fixed payment that is being done at every interval. right? Fixed payment that is being done at every interval. It's just like your yield to maturity. Based on the yield to maturity, how do I find out the spot rates? We have seen in our earlier examples. The same logic, swap rate is on similar lines like yield to maturity, which is a fixed rate for the whole period. So if the yield to maturity is this much, how do I find out the spot rates? Same thing, if the swap rate is this much, how do I find out the spot rate? Once I know the spot rate, I can find out the discount factor, right? So this kind of numerical is something which we have to be comfortable with as far as this, because in this chapter, the only additional thing that has been brought out is the concept of discount factor, which is purely arrived at from the spot rates and the swap rate. Any rate, what is the multiplier to that cash flow is what we are calling as the discount factor.